Welcome back. Four giants of the U.S. banking sector have each reported results this morning, and they've each beaten expectation in their fourth quarter. J.P. Morgan Sachs, Goldman Sachs, Citigroup, and Wells Fargo all reported and all beat. Let's talk about the numbers with our first guest of the show, Philip Peterson, Chief Investment Strategist at IG Wealth Management. Philip, thanks a lot for being here.
Good to be here.
What's your takeaway in these numbers? They're a pretty strong set of numbers, dominated in some cases by trading.
Yes, and I think we're going to see more of this as the year goes on. We are expecting a decent year for 2025 with respect to the markets. We're seeing a strong start to it out of the bank sector anyway. And the banks additionally are going to benefit from a steepening yield curve. So we've seen the yield curve in the U.S., the 210 curve, steepen to about 40 basis points. We think it's going to continue to widen out as the Federal Reserve cuts, but the long end of the curve stays anchored closer to 5%. That's going to make it rather positive for the banks in terms of lending margins going forward.
What's your takeaway on the regulatory environment that the banks are no doubt looking forward to this year? Jamie Dimon at J.P. Morgan says easing regulations doesn't mean dialing up risk. He says that the bank has this renowned balance sheet, and he says that regulations can be eased without increasing risk.
Exactly, and I think that's what's going to be the case for the banks. I mean, they've learned from the credit crisis of 15 years ago not to take on too much risk, otherwise it could destroy the bank. So I don't think they're ready to step back into the arena. Deregulation, I think, can be positive if it's done in the right way, and I think the banks are looking forward to that in order just to expand their business. But I think what Jamie said there in terms of they don't need to take on more risk is true.
Okay, let's go to the U.S. inflation numbers of this morning. The market obviously applauding these numbers.
Yeah, so 2.9% came in as expected, but the core number a little bit lower. That's positive in terms of maybe the Fed isn't going to hold at 4.5% for as long as perhaps the market may have thought, that they're going to gradually work their way down. We still think that the terminal rate for the Fed funds rate is going to be 4%. So we shouldn't get too far ahead of ourselves in terms of anticipating what the Fed's going to do versus what they actually might end up doing.
You say the market, and not for the first time recently, is trying to outdove the Fed. Exactly, and what we mean by that, we saw that last year. A year ago, expectations for the Fed funds rate were cuts of 8 points. 8 cuts through 2024, and we didn't get that at all. Inflation stayed higher than what some had expected, and we think that's going to be the case. So while 2.9% is in line, it's going to be hard to get inflation below that. When we model it out, we see inflation stuck around 3%, could actually trend a little bit higher to 3.5%. That's going to put the Fed in the position where they may only want to cut twice, taking their Fed funds rate down to 4%. You're also tracking sentiment, not only investor sentiment, but consumer sentiment as well. What's that telling you?
Exactly. So what that tells us is when investor sentiment and consumer sentiment is a little bit more euphoric, we perhaps hit a peak and we could start to see things tail off. So it's almost it's a counter trend where if the market is overly enthusiastic on stocks, which is what we're seeing. If you look at the AAII survey of stocks, the weight of stocks in portfolios, it's trending near 70%. And at that level, historically hasn't led to a great outcome. We tend to see corrections following that. That's what we could see. So, on the one hand, we like the banks, as I mentioned. On the other hand, we think that volatility could be kind of the theme for the first half of the year.
What else do you like in terms of portfolio positioning, given the prospects for 2025 and some of the risks, inflation, for instance?
Right. And so inflation being a little bit higher, the way that we think about it is if the Fed's only going to cut twice, if inflation stays higher and we have the 10-year yield trending around 5, then own bonds. Bonds are actually in an attractive position right now. They are going to pay investors that mid-single digits over the next couple of years. And that's a good hedge for equity market volatility and taking advantage of higher interest rates.
What about small cap stocks?
So small cap stocks here, if Trump goes ahead with his tariffs, and look, nobody fully understands exactly what his intent is. He certainly, isn't trying to play Captain America of the politics. But in this sense, when we look at the potential for tariffs imposed by the U.S. on Canada and other countries around the world, one of the areas to hedge that is U.S. small cap companies. U.S. small cap companies are more domestically focused. Also, the small cap index is more weighted by the banks in the United States, so they're a little bit more protected from the impact of tariffs.
Does that mean the valuations in tech will come down?
I would think that the valuations in tech will come down. We've seen them come down over the last couple of weeks, and with inflation being a little bit higher and the longer end of the yield curve trending upwards towards that 5%, it will eventually put pressure on valuations, and the higher valuations of the market should see the bigger contraction.
So we focus mainly on the U.S. market. What is your call on the Canadian market in 2025?
Well, you mentioned oil trending upwards, and it
Right.
has. It's up almost 10% in just a couple of weeks, and this is one area that we can see continue. If we put a target of $85 for oil through 2025, which I think is realistic, especially how we've been trending right now. We're seeing long positions increase, short positions fall off. So there is this push higher for oil prices. If we get to that target, the TSX stands to benefit quite well.
Is that a peak, that target of $85 crude oil, is that a peak or an average for 2025?
No, that would probably be the upper end of the range.
Right.
Yeah.
So you think this rally can stick? Where has this rally come from all of a sudden?
Well, that's a good question. When we look at the data, we are seeing still tight supply. Now, I know just the other day, the EIA came out and said, we're going to see a glut of oil in 2026, but that's a long way off. We don't know what's going to happen between now and then. So we're seeing tight supply, and we're seeing basically the speculators in oil come back into it. So when I mentioned the long interest in oil futures is building and has been building over the past couple of weeks, that tends to lead to higher prices.
Philip, thank you as always for your insight.
Thank you.